Good morning, everybody. Welcome to Friday. Excited as always to be here and to be doing another session of Rebel Income Insights. Hopefully, we'll get a few more people coming in as we get things rolling. But I am grateful for those of you who are here today. And as always, there's plenty to talk about. Let me set up my sharing options and get our screens going the right way. There we go. Really quickly, just by way of just some basic housekeeping, for those of you that may be watching this live stream after the fact, or that may be new to Rebel Income, this excuse me, this live stream is all about looking at the stock market from the standpoint of income generation. Rebel Income is built to focus on trying to generate regular income using the stock market, following a fundamental and value-driven approach, kind of a contrarian approach to the markets, that focuses on generating that income by selling options against the stocks that we focus on. Specifically, we usually like to start with a put sale to set up an opportunity to buy the stock at a price that we like and use the income from that as a starting point. We'll get into some of the details as we look at some of the trades as we get into them. But that's kind of an overview of what we're looking at. Now, this is pretty different than what most people are used to, especially when it comes to options, simply because most of us, when we think about trading options, we're thinking about buying. We're thinking about the buying side of those transactions. They're the ones that brokers will allow you to do the most quickly. And that means if you think a stock is going to go up, you usually buy a call option. If you think it's going to go down, you buy a put option. We're adding a wrinkle to that approach by taking the other side of the transaction. If you're buying, there is somebody else that is selling, and the truth is that in these trades, the probabilities of success, the probabilities of successful trades in these kinds of things for the buyers are actually really low, about 25 to 30%. And that's proven by time. There's a lot of studies. Even if you have ever traded on that basis for any length of time, your own experience will prove it. Mine certainly has. The logical part of that then is that if buying options is going to help you make money so infrequently, then taking the opposite side of the transaction, being the seller rather than the buyer, should flip that script and means you should be able to make money more often than not. And that has proven true. I've been tracking my trades for Rebel Income now for a little over a decade, and I've shifted my own probabilities from those 25 to 30% on the long side to well over 97% success on the selling side. And so this is the core of what the Rebel Income system is built around. Now we can get into a lot of the details about the different elements that play into how we select the stocks that we want to work with, and I write about those in every single one of the alerts that I send out, so that you have a pretty comprehensive view of the criteria that I follow to find these stocks. Today, we're really just talking about how to track these trades and analyze them in real time. And when I say in real time, I'm talking about as the market is moving, as we're looking at what is happening in the market today. How does that price action, whatever the stock is at right now, how does that price action translate to decisions in the moment? How do you manage trades in between trade initiation and trade expiration? All right. So with that in mind, we're going to go ahead and dive in. And the way that I usually do this is just to track and go over the trades that I still have open that I have been sending out alerts for, and we just kind of work down the list, usually chronologically. And that means that really the first thing to talk about here today is Nike. This is a trade that I placed last week that is expiring today. And this one had a little bit of an extra wrinkle to it because earnings came out earlier this week. So that means usually that as stocks are coming up on an earnings report, price volatility tends to increase a little bit more than normal. I apologize, I got something in my eye. As that price volatility starts to increase, what that translates to is to an increase in implied volatility for its options. Now, that's interesting as an income generator because as a seller, that means that the premiums that we can bring in tend to get a little bit inflated, exaggerated, for lack of a better word. In other words, the premiums are usually higher than normal, and they become kind of tempting. Now, that was certainly the case for Nike when I placed this trade. Implied volatility had definitely started to pump up the premiums, and that's why I was able to sell the $69 strike price for $2.23. We'll take a look at this at the stock's price in just a minute to see where this sits. But this is something that is a much higher than normal kind of result for the types of trades that we usually are looking at. This was a trade that only had a 9-day duration. It's expiring today, and so that means that I was able to generate 3.23% for that 9-day period. Sounds pretty impressive, especially when you analyze that. If you excuse me, this is going to be a little bit less than obviously 52 trades because we only have 7 days in a week. But if I divide 365 by 9, that gives us 40 and a half. So I'm just going to round down to 40 trades per year, possibly with the same capital. Now, these numbers that I'm going to run are idealized, so it doesn't necessarily mean you're going to see this all the time. But what I'm trying to do is I'm trying to put in context what these return numbers you see in the L column of my sheet really mean. So if I multiply 40 by 3.23, which was the premium that I was able to generate on Nike, that's 129% per year. Now, that's really, really amazing. It's also not probably not sustainable. And what I mean by that, it's not that there aren't trades to place. There are. It is very, very unusual to see something that is going to give you a 3% or more yield for such a short period of time. My normal target for these trades, if you can see, is usually much lower than that. I'm actually only looking for about 1.5% per month on average, and am typically able to get that within a 2 to 3 week time frame, or even a little bit more. That's why you see numbers like 2.34% here, 1.63, 2.29. These are good examples of what is usually more likely to happen. So that means that these numbers need to be moderated a little bit in most cases. So does that mean that when you have an opportunity to take advantage of implied volatility increasing so you can get more premium, you should? I mean, heck, I brought in a lot more income, $2.23 per share on a stock that, if we look at some of my historical, I've used Nike a number of times. So let's go back and take a look at some of them here. All right, here's been that long, possibly. All right, here's February of Nike. All right, and let's see. Let me find the initial. Here's the put sale, $74 on this one. This was from January of this year. Very normal put sale, actually, bringing in $1.06. In this case, a little under 1.5% for a 15-day time period. That's actually a lot more. So a lot more like the kind of thing I usually expect to see from a put sale under normal market conditions. So this 3.23% is obviously quite a bit more exaggerated. How does that translate to opportunity for risk? I want to try to open this up a little bit, and those of you that are here, I'd appreciate your perspective on this. Is this something that, is the premium too fat to ignore? Is that what drove this trade? Maybe you placed the same trade, maybe you didn't. If you did, was the premium the primary driver? What was the for you? I mean, what was the primary driver for it? If you chose not to, again, what was the prime reason you didn't? Let's get some discussion going on this, because this is something that is kind of this is worth talking about, the temptation to try to maximize return versus managing risk. For perspective, let's go ahead and pull up Nike's stock price, which right now is coming down a little bit below 74. Let me zoom in a little bit more, though. And we go 1, 2, 3, 4, 5, 6, 7, 8, 9. Here is where the stock was when I placed the put sale. And by the way, if you thought that I was just up in the night to place this trade in the first place, I'm okay with that. I want to know. Here's where the stock was at when I placed the put sale. I'm going to put in here PS for put sale right here. Okay. Now my strike price is down here at 69. So it wasn't exactly where the stock was at. I was able to sell a strike price a little bit out of the money, which is a good thing. But what was the risk at this point? Here is the earnings announcement just before the beginning of October. So this lines up roughly with this date. And what is interesting here, oops, sorry, let me use a different color. Let's choose purple. What's interesting is here's where the stock was at, and here's where it opened the next day. Here's an overnight gap from about 70 to about 74. Now, in literal terms, for my put sale, this is a good thing, because this means that my put option is going to expire worthless today. For some traders, that's an ideal result, and this is a good result for me. Don't get me wrong, but it's also not necessarily. I'm not afraid of the other side of this, and this is one of the things we have to think about whenever we're placing a put sell, is that the strike price we're selling is a potential obligation. If the stock had dropped instead of gone up, and I'm going to change my color just for contrast. If instead it was suddenly all the way down here around 66, all of a sudden this would be a much different story right now. I would be looking at taking an assignment with a stock at 69 while it was at 66, $3 lower. And I think this goes to what you're talking about, Gib. He says when IV implied volatility is high, so is the premium, but it tends to naturalize, which brings the premium price down. That's usually true after the fact, and that's one of the reasons why it's tempting to strike when the iron is hot. I'm not going to lie and pretend that the inflated premium was not a factor in my decision to place this trade last week. That was looking very, very attractive. It was also influenced by the fact that Nike was already, even with the increase in price that we've seen since April, going from around 52 down here and now up to where it's at around 70, 74 now, but about 70 when I placed the trade. Even with this pullback, that's still a pretty sizable increase. But even with that increase, the value proposition for Nike is still really, really attractive. The fact that I was able to bring in extra premium was a bonus, but it also meant, hello, Jay, but it also meant that I had to think very, very carefully about this earnings announcement. I had to recognize that was coming up, that the trade that I was going to place was going to cross over that earnings period, and I had to decide whether or not I was willing to accept the potential extra risk of this increase in price volatility. Okay, these gaps after earnings reports. Here's one. Look at this. This is from, what is this, about 62? And I'm just eyeballing, so I'm probably off a little bit, to about 69, maybe 70. That's a much bigger gap. Here's another one. Oops. Right here, that lines up with the earnings report on the downside. So for Nike, it's very, very typical to see price volatility increasing going into an earnings announcement and then seeing some pretty significant movement, even more significant movement following the earnings report, either up or down. Okay, that means that, again, I may not necessarily avoid placing a put selling trade in that case, not just because the premium is fat enough, but if the underlying fundamentals of the business before that earnings report are strong enough, then that may imply that I feel pretty comfortable making the trade. But even if I do that, I have to be willing. I have to tacitly understand and accept the fact that these gaps happen and that I could very possibly end up buying the stock that I'm selling the put option on at a much lower price, right? I may end up buying it at 69 and the stock could be down at 66, or if it was a movement more like this one, good heavens, it might have been all the way down here at 62. It's not in this case, but this is a little bit of the guessing game that you're placing, or that you're playing when you decide not just to sell a put option on any stock, but especially when you're doing it around earnings. This is also why I try to include in my trading alerts. I try to make sure to make it clear that earnings report is coming up, that I am placing that put sell, even though it's crossing. I'm going to hold the trade through the earnings announcement, or that's the plan to, I should say, and also that I am that if you individually are not willing, you don't want to try to play that guessing game, that implied rising implied volatility, rising price volatility is something that makes you a little bit more nervous, then maybe you shouldn't place the trade. So this is really just about trying to make sure that you are thinking the process through, from beginning to end, and not simply doing it because, hey, look at how much money I can make. There's an inflated premium there, and I'm going to go after it. Don't ever do that, unless you are specifically willing to buy the stock at the strike price that you sold. And if there is something coming like an earnings announcement that is going to increase that volatility, then you really, really need to decide whether or not you're willing to accept the unpredictability and uncertainty that naturally comes with it. I hope that makes sense. Any other thoughts, please put them in the chat. If you place the same trade, you have some different numbers. That's awesome. If you didn't, again, I'm interested in perspectives, experience. Um, you know, whatever it is that if you just decided to pass on the trade, that's fine. Just I want to kind of get a sense for what the rest of you have been doing and what you've been seeing with these. All right. So that's where we sit with Nike. Thank you to all those who just jumped in, and I'm really excited to see you. Thanks for joining. Okay, that was Nike, and again, this looks like it's in a pretty good place for me. Barry passed on the trade this time, and that's no criticism, right? This is all about what your individual decision and preference is, and I like it when I see people in our group applying their own decision making process to the trades that I'm highlighting. I don't expect you to trade like a robot. I'm not trading like a robot. I'm trying to take each of these on a case by case basis, and I think that should be something that we're all doing. So, thank you, Barry. I appreciate that. Okay, let's take a look really quickly though, because with Nike in this position, we do have an opportunity to evaluate where that option trade stands. We're going to need to expand the option chain a little bit, but here we go. Now remember, I brought in $2.23 here. Here is the trade. Here is the contract, I should say. The asking price here today, with this thing coming up on expiration, is a 1 cent. That's obviously a function of how far the stock is away from that price. But the question is always that this begs is there an opportunity to buy this option back and maybe hang on to most of the premium? And in this case, I think there is. And this is really interesting because of the distance that the stock has moved. A lot of open interest here, a little bit of volume. That's a little bit not necessarily so important, although it does illustrate that there is some activity on the contract. And if I wanted to buy this back before the market closes, I could. I could even literally just take that asking price of 1 cent, and that trade would likely be filled pretty quickly. Even if I had to wait on it for a little bit, that would be okay. What would be the advantage? The question now is, what's the advantage of buying the option back when I'm already in such a positive position? Why would I do that today, as opposed to just letting the option expire? Now, I know for those of you who have been in this, you've been with with me for a while, you kind of know where I'm going here. But go ahead and bear with me. Feel free to offer your input here as well. But the opportunity here when we're managing our put selling trades, and this is one of the reasons I like to look at every trade that I have in the pipeline, every single week, is that sometimes there's an opportunity to capture 50% or more of the premium that you brought in, to keep that by selling the option back to the market before expiration. This is a little bit more of an advantage if you're doing it, say, a week before expiration, as opposed to the day of, but day of still works too. And here's why. Buying this back immediately closes the obligation. In other words, if something suddenly happened in the market, and there's always a possibility this can happen, even with the stock clearly well above 69. There's entirely possible, maybe unlikely, but still possible, the stock could suddenly pick up a ton of momentum, close down below $69, and force an assignment where I have to buy the stock. By letting the option expire, I'm accepting that possibility, even though it's really unlikely right now. If I were to buy this back, though, right now, pay this 1 cent, I would still get really almost 100% of my premium. I'd give up 1 penny of it in this case. I'd still hang on to the rest of it, and the obligation would end. Gibbs says the ROI on the final 3 days is not worth it. Yes and no. Sometimes it is, sometimes it isn't. The difference here is 3 days, 2 or 3 days. And here's what I mean. You close out the obligation, which means that the capital that you put on reserve for the trade. I sold one contract with a $69 strike price. Since every contract controls 100 shares, that means that the total obligation I have to meet, if I am assigned, is $6,900. I have to keep that money in reserve in my account for the duration of the trade. If I let it expire worthless, that reserve requirement isn't released by my broker for at least 1 or 2 days after, and these are market days, after expiration. So that means that money, that $6,900, doesn't become available for my next trade until Monday or Tuesday. I won't actually, literally speaking, use it until Wednesday of next week. That's one of the reasons why I let it expire worthless. I really don't worry too much about that expiration period. I've already baked it into the way that I trade and the way that I manage these trades, not only for myself, but also how I send out my trade alerts. 3 days doesn't sound like a whole lot, but if you buy this back now, you don't have to deal with that extra waiting period, that settlement period. So that $6,900 becomes available to use right away as soon as the trade clears. So if there's still 3 or 4 hours left in the market, I could, if I have an idea of where else I want to go with the stock, I could redeploy that $6,900 as soon as this trade closes. That can make a difference. Again, if we're talking about a difference of 9 days, which is the duration of this trade, if we think about the difference between 9 days versus 12, okay? Let's say that I was able to do 3.23% every 12 days. 365. We already know on a 9-day basis, we're talking about 129%. Don't worry about the outrageous numbers here for a minute, but if I'm placing a trade every 12 days, that my number of trades drops from 40 to 30. Okay, so I have 10 fewer trades to place. So 3.23% times 30. Now we're at 96.9%. And again, I understand if you could do 96%, almost 100% per year, that's incredible. That's amazing. But what kind of a difference does that 3 days make? This is where I'm going to argue, the final 3 days, it might be worth it. Here's a 30% plus difference just by having the money available to trade again before the trade closes. Again, you're not going to do this every single time. These are simplified numbers just on purpose, because I'm trying to illustrate the point as clearly as possible. This is where some of the people who are in favor of rolling their trades, this is where they create an advantage for themselves. Again, if they can, I said this just a little bit earlier, if you can increase the trading frequency, if you're able to close out these trades and cycle through them, say a week before expiration rather than the day of, you get an even larger advantage because you're increasing the trading frequency by that much more. That's why usually if you can capture at least 50% of the premium that you brought in, and you're a week, 2 weeks from expiration on the trade, maybe the stock has really picked up a lot of momentum in your favor, kind of unexpectedly. That does happen, and so sometimes you're able to do that. Then that can create a similar kind of advantage. So again, it's worth considering and just talking about it, thinking about the numbers, and deciding what it is you want to do. So if this is such a large advantage over what I'm going to do, why aren't I doing it? Honestly, simplicity. It's a little bit makes it a little bit easier for me to manage the system in the context of the things I need to do to manage the Rebel Income Service, as well as just my life, my personal life. And again, I'm not afraid of these. I'm not afraid of these assignments. I don't shy away from them. And so uh, even if the stock has dropped, multiple dollars below the strike price that uh, I've sold, I don't avoid these assignments, because these stocks are also things I look at these trades as opportunities to own stocks that I like at a price that for me represents a useful value. That's also why when you see my trade alerts, I explicitly say I'm selling this put option at $69, for example, with Nike, because I'm willing to buy it at 69. This is a price I like, and the premium is just adding a little bit of extra gravy on the top. That's the income component, the low-hanging fruit of the market. That's why I'm using put selling as the gateway instead of just buying the stock outright, as I get that premium coming in right up front, and then I go from there. Okay, so that's Nike. Let's go ahead and move on from that one, and let's talk about CTRA. We're going to go over the other trade that's coming up for expiration next week is a covered call on BMY that I placed on Wednesday, but we'll get to that one. Let's talk about Coterra Energy first of all. This is a put sale that I placed on the 17th, selling the $24 strike price. This is a 30-day trade, excuse me. So we're coming up, we're still 2 weeks from expiration. We're 2 weeks in, and I was able to generate 2.29% on this. So let's see where that one is at. Barry, CTRA will be added to my portfolio today at 24.50. Okay, hold on a second. So Barry, it sounds like you went with a shorter expiration, a little bit higher strike price, right up here at 24.50, the top of the stock's range since August. That's not a bad thing. Again, if this is a price that you like, right? But this is a good example of what I was just talking about. Now, this is earnings was back here at the end of, or excuse me, at the beginning of August. So we don't need to worry about an earnings report right now. But we do see the stock down at the low end. I'm going to change the color of my marker here. We do see the stock at the low end of its range since August. It's down here at around 23. Nice. Barry brought in 63 cents on a 17-day trade. So that's awesome. And I really appreciate you sharing that. Let's put this in context, especially since this is a stock that, Barry, when you take this assignment today, you're going to be about $1.50 underwater, right? The stock is going to be about that far away from your assignment price. And some people hear underwater on these trades. They tend to, that sounds really, really scary, right? Um, but here's what Barry's setup looks like 63 cents divided by 24.50. It's able to generate a little over 2.5%, 2.57% for a 17-day trade. Now let's apply our same math again. Let's annualize this. So with 17-day expiration, that's possibly up to 21 trades total that you'll be able to place with the same money. Now, again, if we're just talking about one contract, that's $2,450. Yes. I had to think 2450 for a second. So 2.57% times 21 trades. If you can redo this over and over and over again, then this can equate to up to about 54% per year. That's really nice. It's a very nice result. Just by itself, 17 days, you brought in 2.5%. That's nice by itself. So, again, let's talk about the fact that the stock is $1.50 away from that price or likely to be $1.50 away from that price when you take assignment on it. That sounds a little bit scary. Let's not sugarcoat that. That is a reality that you have to contend with. Same time, it's a stock that offers a pretty useful dividend. It's about 88 cents per year, which is attractive. Doesn't totally make up the difference, but it's still useful. And you're taking an assignment. Looks like the next earnings report here is due towards the end of October, around the beginning of November, and their dividend distributions typically follow from that point. They haven't announced their next dividend distribution, but that's about where it's at right now. Barry says that's okay. It should be trading higher sooner or later, and I can start selling calls and collect dividends along the way. And that's exactly right. Again, this boils down to, and this is true whether we're talking about Nike, Coterra, any other stock. When you're selling a put option, you have to go in with the understanding that you could be assigned. Decide if you're willing to accept that assignment, and if you are, what are you going to do with the stock afterwards? Are you going to be patient and just wait for it to come back? That's okay. That's not a bad thing. And if it starts to approach the strike price that you bought the stock at, then you're going to have an opportunity to do exactly what Barry was talking about, and selling covered calls against it. That's what I was able to do with a couple of stocks that I have in my portfolio, one of which was assigned to me last week, and that's BMY. So we'll take a look at that one too. But that's a really, really good example of part of the reason, I don't avoid these assignments is that at some, especially if the fundamental analysis shows that the business is running well and that the value proposition is well above the stock's current price, what that means is that the market is just discounting what's happening. It's not the market is missing out. This is a contrarian view, and when you're looking at stocks in downward trends, and let's face it, Coterra is clearly in a downward trend this year, going down from 29.50 down to its current range at around 23. That's a downward trend. That means net bullish trades on this stock are going against the grain. That's the gist of a contrarian investing approach. But if the valuation is well above that price, then this idea, yeah, Barry says, I won't be ignoring it. It has been a useful trade for a while now. Yeah. And I agree with that, by the way. I've used Coterra on a number of trades with exactly the same mindset, the same logic in place. And this one is still a couple of weeks from expiration. It looks like if the stock stays down in this range, I could take assignment. I've also still got a couple of weeks to expiration. So let's take a look at where the option is, not necessarily to try to figure out if there is something to do with it. I would certainly have to buy the option back at a higher price than what I sold if I wanted to liquidate, if I wanted to close this position now. Here's the $24 strike price. Again, I brought in 63 cents on this one. For my put sale, I'm going to PS 63 cents. And if I wanted to buy this back right now, here's my $24 strike, I'd have to pay $1.42. Barry could possibly be selling calls on it before my determination or expiration date, and you're exactly right. So in the amount of time it took me to decide whether or not I was going to end up buying the stock, he could have brought in premiums not only from the put sale, but also a covered call. So you are 100% right. And that's why I love it when you find a way to apply trading frequency. That's what Barry is doing by working with a shorter expiration here. And you're still able to bring in 2.5% on the stock, right? To take that assignment. So that's, again, I don't hate that. In fact, I love it. I think it's awesome when you can do that. I mean, this is the kind of thing. Barry loves these, I know, but this is one of the reasons I like giving people extra points. Get a tally mark because this is a great application of the income generating mindset of finding what the market is just leaving around for somebody to pick up, but that most people don't. This is why I call it the low hanging fruit of the market. So Barry's exactly right. I'm going to go ahead and let this play out. I don't want to take a loss on this, but the reason that I am pointing this out, this is not what I'm going to do, but for some of our rollers, the objective here is a little bit different. Where I say I'm willing to take assignments, if you're a more active roller, if you're managing these trades more actively than I do, taking an assignment may actually create more problems for your system than it helps. And if that's the case, then buying the option back may make more sense, especially if you're worried that maybe this support line doesn't hold. Because if it doesn't, then there's very possibly some additional downside. I think it's probably not too much below 22.50, which is about where this pivot low was, and that's supported by a low back here in September of last year. But that doesn't mean that the stock hasn't gone lower. Here we are back in 2021, excuse me. Stock down at 14. Here's levels around 18. So, this is not saying that stock is at all-time lows. It's not. So there could be some downside below that. Barry, should you be sharing your screen? If you cannot see my screen right now, please let me know. I had not stopped sharing, so from what I can see, everything looks normal. But I'm certainly willing to redo it. No, can't see. Okay, let's try again. Close-up of me. Well, I don't want that. Is this better? Okay, awesome. I apologize. I had no indication that the sharing had glitched. So thank you for that. I appreciate you letting me know. Okay, so just to kind of backtrack a little bit, we can see that the stock Coterra, here's where major support is right now, and this has been a pretty consistent and persistent low point, or near to, for most of the last couple of years. But it has also been lower just within the last 4. So I don't expect to see the stock have a lot of downside below where it's at, but it could. These ranges, there could be some kind of there could be some kind of a negative news announcement, or whether it's related to Coterra or otherwise, it could push the stock lower. So that's possible, but the business is worth more. At 24.50 for Barry, 23, the stock is worth a lot more than this. So this is a high value stock at this price, at the low end of very low end of a range, and showing some really nice consolidation characteristics that make income generation even more useful, and in my opinion, increases the probabilities of success on these trades, even when you take assignments, even more. So these become really functional, really useful periods of time. Not long ago, it seems, we were trading in the $25 range. Yes, we were. And, that's one of the reasons why when it dropped back down here below 25, I was like, woo, all right, Coterra, we're back. Because, I like to work with stocks that are in my watch list, and that don't go anywhere. And this was one of them. Coterra is a good old friend. So we'll see where this goes. As of now, I'm going to go ahead and I'm going to let this play out. I've still got 2 weeks to expiration, and if this support line holds, it should start to bounce a little bit. The last Thursday and Wednesday of this week were a little bit volatile, pushing the stock back down to support. We'll see if it maintains this stabilization we're seeing right now. Okay, so that's CTRA. Barry, what do you think about Oxy? It pays dividends and seems to be trading lower recently. So let's take a look by way of disclaimer. Occidental Petroleum. I have not done a detailed analysis on this stock. And by the way, when you hear oxy, if you're thinking drugs instead of Occidental Petroleum, eh, that's maybe a different personal issue. But that's fine. And if that makes you laugh, then so be it. Okay. Interesting. It's picking up some momentum here just the last 3 days, isn't it? But what we have is the pretty nice gradual uptrend that has brought the stock. Even with this decline here, we're still at about 45 from about 34. So that's interesting. Again, I can't speak to this latest move other than to say that it broke down below the 200-day moving average. It looks like it's trying to stabilize, and it should have some pretty solid support right here around 44. Just look at all of the chop of the past 4 or 5 months in that price range. Why it hasn't hit my radar, to be honest, it just wasn't on my watch list. Really no other reason than that, but this looks like it's worth it. So, okay. I need to go. I downgraded my trading view, so looks like I may need to put this in a different watch list. But this is certainly worth paying attention to. The dividend on this one, not huge, about 2.13%. That is useful. The fact that it pays the dividend is more important than the fact that it isn't huge. I'm a little bit loaded right now in terms of energy stocks in my portfolio, so I am going to be a little bit cautious about adding more. But this certainly looks interesting. I know I've looked at Occidental in the past, Barry, and for other different reasons at the time, didn't keep it in a watch list because it didn't fit my criteria. So yeah, Walmart does pay a dividend, but just barely useful. And the criteria here for Rebel Income is not the size of the dividend, but just whether or not they do pay a dividend. So technically, Walmart does fit in, and it does cross my desk from time to time. I've got it in my watch list. But yeah, you for each of us, there's a little bit of a different evaluation as to what we're willing to work with or what we're not. But this certainly looks interesting. I think it's certainly worth taking through some evaluation. And so you might see a report on Occidental here in the next few days. Thank you. I appreciate it, Barry. I'm going to go ahead. I'm going to pull up their options changes to see what it looks like. Yeah, you've had Walmart for a while, as I recall, Barry. He says he's got a 105 call on Walmart, and he's in at around 66. So, I'm really sorry for your suffering on this one. 105 is a little bit above its current range. The top, come on, just give me I don't know why it did that. Top of this range is up here closer to about 103, 104. So 105 is a little bit above, but hey, you're baking in a little bit of extra capital gain that way. That's not bad. So, okay, let's brought in $1.75 for 28-day trade. You're in at 66, so that's even better, right? $1.78. Sorry, divided by 66. So 28 days, you got 2.69%. Hey, remember I said if I can get 1.5%, I'm happy. That's nice. So Barry gets another tick mark. There you go. Okay, let's take a look, check in here. Got it shortly after the split. That's awesome. Okay, let's go ahead and check in on the next put sale, and this is one that doesn't expire until the 17th as well, just like CTRA. Um, this is this week's put sale. This is Skyworks. I sold the $74 strike price and was able to bring in a little under 2.5% for the 2-week trade. Skyworks is another stock that I've been using quite a bit lately, and that has been really functional. And in this case, this trade is a little bit of a case of taking advantage of this upward trend. Sometimes you get to do this. Not always, because very often when an upward trend starts in a stock that I'm working with Rebel Income, um, very often it moves fairly quickly beyond the price that represents a useful value. But Skyworks is really interesting because they've rallied all the way from 48. Now they're up here around 78. They've rallied by more than 50% since April, and yet their value proposition is still pretty attractive. It's still around with my put sale around 74, still about 20% upside, which is nice. Um, so the stock's at 78 right now. This is interesting. I've only been in this trade for a few days, 2 days in fact, but I sold the 74, brought in $1.80, and that move is enough. Let's just take a look. This doesn't happen very often, not in 2 days anyway, but sometimes. Skyworks is also an interesting one because the stock used to offer weekly options. Now they don't. Now they're just monthly. But here's okay. That was a typo. This was 75, not 74. Excuse me. I sold the $75 strike. Had to correct myself right there. Okay, I sold 75, and right now, 2 days from expiration, $1.20 on this. So it is worth a little bit less than what I brought in. Brought in $1.80. Not quite enough though to worry about whether or not there's an opportunity to cycle it. But it's at $1.20 now. So in just 2 days, the stock's price activity has increased on the bullish side enough that I'm already up on this. I'm net positive by 60 cents. For a roller, that's generally not enough to justify trying to roll the trade. But it does mean that over the weekend we've got 3 days of time decay going on right between now and next Monday when the market opens again. That's going to erode the value a little bit more, and then depending on what the stock is doing Monday, Tuesday, this could be even more amplified. We'll see. Um, Certainly, when we come back next week, there will be an opportunity to evaluate this as well. But for now, this is sitting in a pretty nice place. My other trades here covered calls. I mentioned BMY. This is one I took assignment on last week, and I was able to sell after being assigned at 46. I was able to sell $47 strike price, and just checking in on this one. Been a little bit volatile. This is why I was able to sell 47. Got a big move to the upside, and now it's coming back a bit. Again, it's a little bit below my $46 strike price right now, so we'll see where this ends up by next Friday. I don't know, but I'm willing to let it play out. This covered call trade. This is a really good example of just something that became available in terms of, you want to talk about low hanging fruit, right? It became available, and there was an opportunity to, quote unquote, strike while the iron's hot. That's what this was. And that's nice when you have that opportunity and you can react to it quickly enough to be nimble and capture that. Then that's an advantage. This is why I talk so much about it. I'm hoping that you're watching your own positions as well, and you're making some of these same decisions, kind of like what we've seen Barry doing. So that again, we'll see where this one goes, but that's where it's at for now. The only other open trade, and I know we're at time, but I'm going to just pull this up really quickly, is on Schlumberger. Again, this is one that I was assigned at 36 and and this week I was able to sell exactly the same strike price. I'm selling the same strike price that I bought at because it's 2% for 2 weeks. That's a nice premium. I don't know if the stock's going to push above it or drop below it before expiration, but I figured even if I get called out at the same price that I bought it at, that's still 2% that was just waiting to be picked up. And the stock is about $1.50 away from that right now. Again, we had a little bit of extra volatility in the last 2 days when I placed the trade that enabled me to sell. Here's the price that I was assigned at. And I've held Schlumberger for a little bit. Good portion of the consolidation period that we've held here. This is a good example of a stock where the consolidation has worked out okay. I've actually been able to place a number of functional covered call trades here and still holding on to the stock, still bringing in the dividends. Which, that's 3.31% annualized. So this is one, we'll see where this goes. My last covered call trade on Schlumberger expired. This is the next one. At some point, I'll get called out, and that's fine. So in the meantime, this is a very contrarian setup because of the length of the downward trend. This one goes all the way back to 2023. And so this consolidation period, the longer this lasts, the more interesting it becomes. Okay. All right. Well, we are at time, as I mentioned. So everybody that is still here, thank you so much for your time. I do appreciate it. If this live stream is useful to you, please help me out. Help me continue to grow the Rebel Income community. Share it with your friends. This until a couple of months ago, this live stream was something that I was only making available for paying subscribers, paying clients. But I'm opening this up to everybody. This is a public live stream, and I want to try to encourage as many people as possible to join it as an opportunity to see what we're doing with our Rebel Income trades and hopefully see the Rebel Income community grow. So please share it with people that you think might benefit from it. Otherwise, as always, have a wonderful weekend. I hope that you get an opportunity to spend time with loved ones and do some fun things. If you have questions between now and then, reach out to me. rebelincomesystem@gmail.com is my email address. You can also reach out to me on Discord or on Substack. Thanks again. Talk to you next time.